Hello, and welcome to the CFA's latest In Conversation podcast. This podcast is for investment professionals that are focusing on topics that really matter to the profession today. I'm Christopher Ware, CFA, and joining me today is Edoardo Gili, CFA, Senior Analyst Equity Research at Green Street, who are sponsoring this episode. Green Street is a forward-thinking real assets company at the forefront of transforming the commercial real estate market with cutting-edge predictive analytics, data-driven insights, and actionable intelligence. Today, we'll be talking about REITs and real estate private markets, and we'll also have an exclusive section of this interview available on CFA UK's professional learning platform. Edoardo, welcome.
Thank you for having me.
It'd be great to hear a bit more about yourself before we start, and indeed a bit more about Green Street as well.
Yeah, for sure. I'll start with Green Street. So we've been around for over 40 years. And our mission within the commercial real estate space and infrastructure space, which we see combined as real assets, is to provide analytics, research, data, news, and advisory services to our clients. We're covering and we're present in North America, we're present in the UK, in Europe, and very shortly in Australia as well. We're unvarnished, we're independent, we're unbiased. Our sole mission is to help our clients, which are private equity investors, public equity investors, to understand markets, to understand real estate sectors, infrastructure spaces, and how to best allocate capital. So this is our mission. And then for me, I'm Edoardo. I've been at Green Street for 8 years. I have a background in economics, in finance. I'm passionate about real estate and infrastructure. This is what we do day in, day out.
So maybe let's start with a broad question. We're thinking about asset allocation. Where does real estate sit within that universe? How does it interact with other sectors? And is there overlap with infrastructure, for example?
Yeah, it's a very good question. So when we look at real estate, I think it's a bit of a misconception sometimes when we look at what investors think of real estate, where in the past has been sort of seen and perceived as a passive investment, let and forget. We've heard these sentences, especially in the office space or retail space, over the past couple of decades. But real estate is changing, and it's changing very quickly. It's becoming a lot more operationally intensive across niche sectors, alternative sectors, which include hotels, healthcare, but also traditional sectors such as retail and shopping centers, office as well. We see a trend in co-working and flex offices as well, where the operational intensity of the real estate industry has grown very, very fast. So within that framework, real estate belongs in everyone's portfolio. And it's difficult to say, in terms of how much in terms of exposure, because that's very different depending on the risk appetite or the horizon of select investors. But you can access real estate investments across multiple vehicles, right? And we're going to talk about that. But REITs, of course, on the public side, private equity, but you can also look at credit, listed credit, private credit. And across all these wrappers, all these vehicles, there's an investment vehicle that's probably suitable for most investors out there. Within these vehicles, within the real estate industry, there are many, many sectors. And these sectors have different tailwinds and headwinds. And therefore, sort of a better understanding and a more sophisticated understanding of these sectors is paramount to be an outperformer in the property universe. Hopefully that answers your question.
Certainly does.
And I think you mentioned the infrastructure element as well, which is a fascinating thing that's ongoing now in the property space, because at Green Street we look at commercial real estate as infrastructure as part of real assets. And we think that going forward, there will be a lot more integration between these two subsectors of real assets. And we're already seeing quite a bit of, I would say, amalgamation or lines blurring between these two investment classes, where especially if you look at healthcare, a lot of investors will look at healthcare as commercial real estate, but also investors will look at healthcare as infrastructure, right? Primary care, hospitals, care homes, all of these sub-asset classes in healthcare could fit into an infrastructure strategy, but also a commercial real estate strategy. And we're seeing that across many sectors, including digital infrastructure. You have cell towers in the US, which are REITs, right? So real estate. You have data centers as well, which are going to sit in between. Transportation also sitting in between. So you have a lot of, I would say, amalgamation between the two, and this is the right way to perceive the real asset, I would say, sector going forward, because the synergies between the two are very, very good.
Absolutely, no, I totally agree. I suppose to move on from that slightly maybe, so real estate is often seen as a very cyclical industry. Where would you say broadly we are right now, and does that differ across the UK, mainland Europe and the US?
Yeah, of course. So when we look at sort of in the life cycle of real estate and where are we now in the cycle, since 2022, valuations have come down by 25% on average in Europe, and a little bit less than that in the US. And there are quite a bit of divergence between the sectors in real estate. So office been the worst performer, hotels have been the best performer. But within the commercial real estate sector, we've seen valuations come down 25%. Our way to tell whether real estate is cheap or expensive is to really benchmark it against the bond markets. And we look at bond pricing for investment grade, we look at bond pricing for high yields. And we have 40 years of data in the US and 20 years of data in Europe that tells us that risk-adjusted unlevered returns in the property space have yielded 200 basis points above sort of investment grade bonds in the long term, right? And when we look at it from that lens, real estate today in Europe screens pretty cheap on the private market, also on the public market. US is in between, and UK is the most expensive geography in the commercial real estate space right now. And that's solely based on risk-adjusted return expectations that we have across sectors, and I'm using here an average, versus where the bond market currently is.
Thank you. That is interesting. I think we'll come back to some sector specifics a bit later on. I think to go back to the sector allocation, or asset allocation, I should say. As you said, an investor has the opportunity of allocating to either private market real estate or public market, whether that's a REIT or an investment trust. Why would an investor pick one or other?
So we have done these studies many times, and whether it's private market real estate or public market real estate, it is real estate. So in the long term, the performance converges between the two. Now, you look at these two different vehicles, two different wrappers, right, of investing in real estate, and there are idiosyncratic differences between the two, right? If you look at public REITs, well, it's a lot more volatile, and some investors will look at volatility as a risk measure, which we fully disagree with, right? Volatility is not risk. Risk is what's the probability you're going to lose your money and how much, right? But REITs are volatile. REITs are liquid, right? And also you have the public market angle to investing in REITs, right? So the investor base of REITs is different. Some investors are more short-termist versus long-termist. The customs around leverage are a little bit different as well. The public market requires lower leverage than private market. So you have differences between the two, but in the long term it converges because it's all real estate. And so from that perspective, what we really care about is risk-adjusted returns. So where do you find the cheapest way to invest in real estate with the lowest risk? And this is where you should go overweight or underweight. When we look at certain investors, we're sometimes quite surprised that public market or investors or REIT specialists and private market investors in real estate often don't necessarily talk to each other, right? And we think that it's such an easy way to find synergies between the two and understand whether a sector is overvalued or undervalued and why, when you can sort of play between these two fields, and where ultimately the performance will converge. So there is a lot of arbitrage opportunities between the two. So we're very big proponents of mixing investment strategies between private market and public market in the real estate space.
Yeah, no, I would totally agree that investors don't seem to talk to each other.
Yeah.
What screen's cheaper at the moment, and does that differ maybe between equity and debt on the real estate side?
When we look at between private and public real estate
markets
right now, and when we look at just globally, both screen relatively cheap again versus what the bond market is telling us. There are of course discrepancies between geographies. We look at North America, North America, Europe, and the UK. But both look reasonably cheap, and REITs look slightly cheaper, not that much more cheaper. The reason why is because you may see a lot of REITs trading at discounts to NAVs, and those NAVs are often published by companies themselves, and may not be fully accurate in real time. So you may see discounts, and I may tell you, okay, maybe REITs are cheap, but when we adjust for overhead costs, right? Which is, you look at a REIT, you look at how much do you spend as an investor on a management team, for example, to operate the REIT. When you adjust for that, when you adjust for corporate governance, when you adjust for certain balance sheet risks, REITs screen cheaper than private market real estate right now, but not that much cheaper. And always and I'll reiterate my point here, when we look at what screens cheap versus expensive is always versus the benchmark of, the lens of the bond market from that perspective.
I see. And is that any different if you're looking at mortgage REITs versus private market debt at the moment?
When we look at credit, it really depends on the geography. So when we look at one of the reasons why we like continental Europe right now as a real estate investment strategy is because the bond pricing is so much more favorable for equity investors. It's not the case in the UK, and it's less the case in the US. So from that perspective, and I'm not going to comment on mortgage REITs, which is sort of outside my scope of competence, but I would argue that the bond market is more expensive on the continent, and perhaps cheaper in the UK. Hence, the value proposition of real estate between these two geographies is very different right now.
To change tack slightly, I think at a university textbook it would tell you that real estate is often an inflation hedge.
Yep.
However, you'd say the last 2 years,
Yep.
inflation spike, actually real estate has performed quite badly,
Yep.
obviously due to those raising of the base rates in various central banks around the world. Do you think this will change allocators' views in the future, or do you think the thesis still holds?
I'll answer your question in two parts. So real estate is an inflation hedge, but not always. And oftentimes we think that inflation hedge characteristic or argument is oftentimes overestimated, because it only works as an inflation hedge if the demand-supply equation is favorable, right? If you don't have that, you're not going to be inflation hedge. That's point number one. And point number two, what happened over the past 3 years is that rates have gone up. And what matters for valuation of real estate, and valuation of any kind of business, but real estate specifically, what matters is your cash flow and your discount rate, right? Your cash flow in real estate, we talk about net operating income, NOI. Your discount rate, we talk about cap rates, right? Capitalization rates. What's happened over the past 3 years that we've seen the capitalization rates go up, but there are many ways and many reasons why capitalization rates go up, right? What we've seen is that real yields have driven the bus. Real yields have gone up the most. If you look at inflation expectations, they've remained pretty steady over the past 3 years, despite the inflation surge from 22 to 24. Inflation expectations in the long term, they've remained pretty steady across the globe. So nominal rates, which is real yields plus inflation expectations, have gone up, mostly because of real yields. And then the third component of cap rates, when it comes to valuation of real estate, is credit spreads, right? And right now they're as tight as perhaps they've ever been. So what's been really the driver of valuations over the past couple of years has been real yields and not necessarily inflation expectations. And real yields hurt all risk assets, including REITs, including private market real estate. And what does it hurt most? It hurts asset classes that have sort of low cap rates, right? High multiples and called long duration. And that's what real estate tends to be. And therefore, that explains the underperformance of real estate as an asset class, right? If you look within real estate, there's, again, big divergence. If you look at hotels, hotel values are up. Why they're up? Because cap rates are higher for hotels, right? Because it's an very operationally heavy sector. So shorter duration by definition versus, for example, residential. And at the same time, you've had the post-pandemic surge in, we call it revenge travel, where hotels have sort of outperformed from that perspective, and cash flow has risen. And so the values of hotels have gone up since 2022, approximately 5-6% on our numbers, and the values of residential, for example, are down over 25%. So it's all of these characteristics that come into play. But the main driver of valuation movements over the past 2 years have been real yields, which have come from negative territory to, in the UK, 2% now. So, yeah.
A number of REITs and listed vehicles in the UK and Europe have experienced M&A activity in the last year. What do you think is behind that?
To us, it's very unsurprising. So, what's happened in the listed space, and it's true in continental Europe, especially true in the UK, is that during the zero interest rate policy world, real estate was booming for obvious reasons, right? And you could be a suboptimal, I would say, small, inefficient, poorly structured REIT and have a reason to be, because interest rates were close to zero and real yields were negative. With the rise of interest rates over the past 3 years, it kind of shows that if you don't have a competitive advantage in terms of operational expertise, if you don't have a well-structured REIT in terms of corporate governance, in terms of balance sheet, you're going to be trading at a discount. And you perhaps lack the economies of scale as well to make yourself efficient. So therefore, you're expensive for investors, and therefore the discount is warranted. And by discount, I mean discounts to net asset values. And if you're a REIT that perennially trades at discounts, it's difficult to grow, right? Because REITs, by definition, need to distribute cash flows to investors, and therefore they can't reinvest cash flows into investments. So from that perspective, it kind of puts you in a penalty box, and it's difficult to really grow from there. But these REITs sometimes have really good portfolios, and they fit really well in bigger, more institutionalized, more efficient, better managed REITs. And this is the wave that we've seen, especially in the UK over the past 2 years. So to us, it's unsurprising for one, and it's also a good thing. And we're not proponents of size, right? We're proponents of performance. But we've reached a point in the UK and Europe where size actually matters in terms of finding economies of scale and being an operationally driven and efficient platform. And too many REITs are too small and fit better into a bigger strategy. And then the cost of capital discrepancy between some of those smaller REITs and the bigger REITs have grown so wide that M&A activity is warranted, and also the economics make sense, not only strategically but financially. Such thesis makes sense now. So we expect to see more of it. We've seen quite a bit of it in the UK. We expect to see more of it in continental Europe as well. But it is something that needs to happen. If you look at the average size of a REIT in Europe versus the US, I mean, we're talking magnitudes smaller, which is a problem also in terms of liquidity for larger investors trying to invest in REITs. So you need critical size, you need critical mass. So we expect that to continue, and we don't expect that to be necessarily negative when the acquirer doesn't overpay. And in M&A, as you probably know, it oftentimes happens that acquirer overpays for a target. But right now we're seeing deals, not all deals, but some deals where the marriage makes a lot of sense strategically and financially for investors. So,
what is interesting more generally, I think, is whether, I know you say it's not a bad thing, and I don't disagree with that. I suppose the question really is for the retail investor maybe, or the small institution who can't access, a Blackstone or a big private market player, does that mean actually it's much harder to allocate to real estate if there are fewer listed vehicles to take your money? I think that's quite an interesting angle.
Yeah.
In fact, maybe.
No, it's a very good question. It's also a concern that many not only retail investors but also specialist investors are voicing. To us, it's almost creative destruction, right? Where if public market pricing becomes favorable again, you're going to see a ton of IPOs, right? And then private equity will need to exit some of those portfolios. So for the public market to trade attractively, so at a premium to net asset value, you need to have stronger, better, more efficient, institutionalized REITs that are attractive, right? And then you can sell that story for private equity trying to exit large-scale portfolios, which we think will happen more and more over the next couple of years, because private equity's cost of capital has deteriorated meaningfully. So from that perspective, I understand the concern, but I don't. It's not ours, right? We do think that IPOs are going to come back. It's just the capital flows between private and public, and in a high functioning capital market environment, these happen. And I wouldn't say that's the biggest concern. I would say for us the biggest concern is acquirers could overpay, and then when that happens, well, it's good for the target, especially if it's a cash offer, and targets can exit. But for investors left, sometimes you have to contend with a weaker portfolio or elevated leverage and things like that, which to us it's a bigger risk than seeing less REITs, right? I think we could live now, I think, in Europe with potentially less REITs right now, but that could grow in the next couple of years because of IPO activity.
Okay, and then I think it'd be interesting just to dig a bit into why you think REITs in the UK but also Europe just haven't quite worked. So 2007 maybe that came in.
Yep.
It took them 10 years of legislation to get to that point.
Yep.
Obviously the financial crisis didn't help those first few years.
Yep.
But it's now been 20 years since.
Yep.
They haven't really taken off as in the US.
Yep.
Is that just related to the depth of the equity markets?
There's a lot of reasons for that. It's a fascinating question, but since pre-global financial crisis, US REITs have grown fivefold as a market cap, right? US REITs now are over a $1.3 trillion market cap. It's been a fantastic, successful story. In Europe, it's the UK and continental Europe, market size of REITs has grown by 30% in the same time period, right? So it hasn't worked. Why is that? Well, a couple of reasons for that. Number one is things you can't control, right? It's been a one-way street in terms of capital flows into the US, right? And this is not a REIT-specific comment. It's an equity market specific comment, right? And REITs European REITs have suffered from that angle. But now, more interestingly, we think that European REITs, including the UK, have been much poor capital allocators over the past 15, 20 years. What do we mean by that? We mean that for us, the reason to be for a REIT is to effectively grow and compound earnings over the long term without diluting your portfolio quality, without compromising your balance sheet, and without taking too much risk. And by too much risk, we mean ground up developments, going up the risk curve, too much as a percentage of your total real estate portfolio. If you can do that over the long term, you deserve a premium and you will grow, right? And a lot of REITs in the US have understood that post GFC. In Europe, we've seen management teams often struggle with the right capital allocation strategy and how to create value for investors, which oftentimes needs to be related to risk-adjusted returns of available on acquisitions. How does that compare with your own cost of capital? There's a multitude of ways to look at your own cost of capital, and we think that management teams in Europe oftentimes focus too much on their published NAVs. In the US, REITs don't publish NAVs. So everyone has an NAV, and it makes it more efficient, more real time, and just a better tool. In Europe and the UK, companies report NAVs, and that's used as a benchmark. I'm trading below NAV, above NAV. If I'm trading above NAV, I can issue equity and I can grow. If I'm trading below NAV, I can't. But NAVs, when you have a market that's been a private market, an investment market, which has been less liquid, and where the bid-ask spread has expanded since 2022, it's much tougher to see where it is. That's the first issue. REITs haven't grown when they should have grown, basically, because the yardstick, their own cost of capital, has not been the right one. I think secondly, the attitude towards leverage has been not as good as in the US. In the US, most REITs probably have 4.5, 5 times net debt to EBITDA, which is adequate. In Europe, it's oftentimes you'll see over especially continental Europe, you'll see over 8 times, over 9 times. In the UK, it's been much better, much closer to the US. But the attitude towards capital structure and leverage has been, I would say, riskier and more detrimental to the growth of REITs. REITs should grow via equity first and foremost, and debt should be a tool in that growth. But when we see REITs with net leverage over 30-35%, and that depends on the sector, sectors which are more defensive, you can have slightly higher leverage, and more cyclical sectors, more lower leverage. But if you see over 50% net leverage for vehicles that are tax exempt effectively, so you don't have any tax shield to play with or to take to your advantage, then it's we don't see that as a good thing. And I think the attitude towards capital structure has been detrimental to the growth of REITs in Europe and the UK. Other reasons include also corporate governance is slightly worse in Europe in terms of alignment between management teams and investors. If you look at the US, CEOs tend to have much more skin in the game than in Europe, and we like to see CEOs that own 5 times their base pay in equity ownership in the REITs they manage, and in Europe it's half that, right? So there's an element of alignment with investors as well, which will drive you to better decision making in terms of allocation of capital, but also capital structure, right? So that's one thing that's also been a problem over the past 15 years. Transparency as well in terms of management teams and disclosures. You have a lot of American investors who are interested in the fundamentals in Europe, which are good, but oftentimes it's more difficult to understand the equity story if disclosure is not as transparent. There are many reasons for why European REITs have sort of underperformed in terms of size versus American REITs. But it's not too late. Things can always change, especially when fundamentals in Europe and the UK are pretty good in terms of demand supply. We just think it's a matter of taking advantage of that and understanding the reason to be of REITs, and selling your story to investors, and understand that you can compound earnings over the long term.
Absolutely. I think there's an interesting point there that a number, particularly in the UK, of companies became REITs overnight without thinking it through, and they did not change their structure. They were a property company or a development company. They then became a REIT and thought they could just carry on with their same business, but with a slight tax advantaged model. And I'd agree, I think that's caused many of them issues. I'd love to just dive in a bit more to the NAV point. As you know, especially in the UK, investment trusts or REITs are always talked about in terms of NAV. That's the one metric that is discussed. And I'd be interested to get your thoughts on how detrimental that is to the sector as a whole. There is no other sector where you'd focus purely on price to book. It would be within the round, you'd talk about cash flow growth, you'd talk about asset growth. What are the potential future opportunities for the company? Is that holding the sector back? Do you think a focus on cash flow would be far more helpful?
I think the NAV approach is useful, but you need to have the right NAV. That's for one, right? Once you have the right NAV, NAV discounts and premiums, it's a valuation metric that should be seen within more a holistic approach of looking at REITs, right? And we tend to think that REITs are in the long term, they're NAV machines, right? So you want to see a REIT that will grow NAV per share plus dividend payments. That's what's going to matter in the long term. So why would NAV grow? Because of NOI, right? And then potentially cap rate compression as well. But we care more about sort of cash flow growth. In the long term, that's what's going to matter. In the short term, REITs also have to contend with earnings growth as well, right? And that matters as well. So you need to look at both aspects of valuation, and at the same time understand that you need to have a path of free cash flow growth to equity in the long term, right? And then if you anchor too much on your own pricing versus your own NAV, and if that is the main driver of your own capital allocation, you may miss out on really good opportunities, right? You may trade at an implied yield. So by implied yield, we mean derived by the share price, right, of the REIT. You may trade at a 5% implied yield, and you could acquire a good portfolio at maybe at a 7% yield, but you could still trade at a discount to NAV. To us, when we see those kinds of opportunities, if it's not dilutive to your portfolio quality, not compromising your balance sheet, and not riskier than what you currently own, we think you should raise equity all day. But if you're trading at a discount, you need to sell that story to some investors who may not understand, the true sort of what truly matters in terms of valuation metrics, and it may not lead to the right decision, right? So from that perspective, we do think that there may be too much anchoring and reported in NAVs, especially now, because a lot of REITs, especially in the UK, are trading at discounts to NAVs. Even our NAVs, where our NAVs tend to be lower than what companies disclose. So we don't think it's an important tool, right? If you're trading at a discount to NAV, you should think, why am I growing at all? But it simply tells you that your hurdle for growth is so much higher. But it doesn't mean that you can't grow, right? So it's an important metric, but it's not the only one. And I think what truly matters in the long term is your ability to generate sort of free cash flow to equity consistently, right?
Yeah, no, that definitely makes sense. And I think part of that sort of raising capital, whether in public market or private markets, is obviously the story. Yeah. And so many companies over the last decade in particular have really focused on thematic investing, whether that be distribution or life science or residential. So I think maybe we could talk a little bit about credit markets. Yeah. I think we've all sort of read about sort of big banks moving away from direct real estate lending or doing less of it, and there's sort of either challenger banks or indeed debt funds moving into the space. But on the ground, I mean, how much liquidity really is there, and does that differ from the core up to the opportunistic level?
Yeah, it's right now credit markets, I would say, are pretty liquid. I would say even terms are pretty loose sometimes. So when you look at whether it's public credit, private credit, availability of capital is very much there, and that's especially true in Europe, a bit less so in the UK, but it's a very healthy credit market out there, which is great for sponsors and equity investors. Is it available for all sectors? It depends, right? Financing a office development now will be tough. Financing residential is always fine, right? So it depends per sector, but as a whole, especially versus 2022, where you didn't have a credit crunch, but availability of capital was much lower than it is today. We see the markets as pretty healthy, where margins for unsecured, investment grade issuers, probably around 150 basis points over base rates, which is pretty healthy. From that perspective, is it available across the risk curve? Certainly for stabilized assets, core plus. Also available for value add and opportunistic, but I would say less with requirements or constraints that are a bit higher than they were during the zero interest rate policy era. From that perspective, you're going to have lower LTV, requirements from financing companies. You're going to have more stringent ICR covenants as well. But from that perspective, pricing is pretty attractive for equity investors now, especially in the eurozone. So from that perspective, it helps real estate markets being liquid, being attractive. A lot of investors require to be in positive leverage territory to make investment decisions. That's something that we're observing in the eurozone. Not quite always in the UK or the US, but we're getting to a very I would say favorable market. From that perspective, I would say what's more favorable now, I would say, residential and data centers and hotels. You also find retail in certain countries, not all, even though we like retail as an asset class, and we think banks should be a lot more friendly to the space. Industrial also is much easier to finance. So we don't see a problem in that field like we may have seen in 2022. It's gotten a lot better. At the same time, cost of debt has gone up because base rates have gone up. So that is sometimes an issue in terms of refinancing and equity cash flow growth for investors. But because the fundamentals are pretty attractive across the board, supply, demand, and the ability to push NOI in the right sector and for the right management team, you'll be able to weather that potential negative hit from refinancing if you had cheaper financing from a couple of years ago. So that is something that we see coming, but we don't see a problem in terms of refinancings or anything like that.
Okay, and then just to continue on the credit front, on the development side, obviously build costs have gone up across the board, no matter what sector you are in. How much of an issue is that putting on the sort of the value add opportunistic end of the equity market, given that debt costs have gone up, and as you say, ICR coverage is probably a bit more stringent than it ever used to be?
If we look at replacement cost, which is a tremendously important metric when we look at investment decisions, they've gone up quite a bit since the inflation spike in 2021-22, around 20-25% across the board. They've gone down from their peak, but they're much higher than they were, and that's not only labor, it's not only materials, it's also financing. It's also financing costs. That puts pressure on land values and also puts pressure on the hurdle to develop more. That's a good thing if you own real estate, right? If you own stabilized assets, that means supply is going to be pretty constrained, and so we're seeing across the board. If you're a developer, it's a much tougher story to stomach. But we do see it for owners of real estate now, where we see supply activity being quite measured, quite constrained. It's a good thing for NOI growth because the demand is there across various sectors. So from that perspective, it's not good for everyone. It's good for certain people. It's not good for other players. But everything will adjust. So when we look at replacement costs, they've gone up. So that means that replacement rental values have gone up as well. And oftentimes development activity doesn't make economic sense. But it does make economic sense in certain sectors. We see that, for example, in logistics now, where the economics are reasonably attractive in terms of developing more big box or last mile assets if you can find the land for last mile. So from that perspective, it's really sector specific. It's also geographic specific. And also it depends on the type of value add or even opportunistic investments you're targeting.
So I think that's all we have time for. Edoardo, thank you so much for doing this. And thank you also to Green Street for sponsoring it. We hope you enjoyed the episode. Please remember to look out for the next episode of our In Conversation podcast through the usual CFA UK email and social media channels. You can also subscribe so you don't miss an episode through CFA UK's SoundCloud channel, Spotify, or Apple Podcasts. Until next time, goodbye.
It's been a pleasure. Thank you. Bye-bye.